Hey guys, let's take a look at this problem. Beach Motors Incorporated assembles and sells dune buggy engines. The company began operations on July 1st, 2014 and operates at 100% of capacity during the first month. The following data summarize the results for July. We can see here that we sold 30,000 units and brought in $9 million. The production cost here for 40,500 units. So we can see here we produced more than what we sold, right? And excuse me, let's see if I can get this thing to go away. That's going to be kind of problematic there. But anyways, 4,495,500 is the total amount of the cost of those direct materials. The direct labor was 2,187,000. Variable factory overhead was $1,093,500, and the fixed factory overhead was $729,000. All that collectively is $8,505,000. Okay, now that is just for the production of 40,500 units. Some of these guys are fixed, some of these guys are variable. And if we look at our selling and administrative expenses, we have these guys broken into their variable and their fixed components, and they total $1,485,000. Now, because the cost behavior is very different for variable cost and fixed costs, we're going to see that there's going to be some differences between the absorption costing income statement and the variable costing income statement. And what this asks us to do is to produce an income statement under both methods, income statement under absorption and variable costing, and to explain the difference. Now we know that the difference is going to relate to the $729,000 right here. That's the fixed factory overhead. And under absorption costing, we're going to treat that as being a product cost. And remember, product costs are kept on the balance sheet as a part of inventory, which is an asset until they are sold, and at that point in time it's expensed. And under variable costing, we're going to treat fixed factory overhead is something that we're going to expense fully in the period that we incur it, and we call that type of expense a period expense. So that's expense just like any other type of expense would be. And if it's a product cost, it stays on the balance sheet as an asset until the period in which it is actually sold. And 2, 3, 4 years, accounting periods might go past before these things actually sell. So we're going to notice that there's going to be a difference in these two types of income statements, the variable and the fixed. There's going to be a difference when we have a situation where the number that we sell is different from the number that we produce. Okay, let's take a look at what the solution key is going to look like. Okay, so the first thing that we're going to do is going to be prepare an absorption costing income statement. This is the type that we've seen before in the Principles of Accounting class, and this is also what we started out working in this course. And the next thing that we're going to produce is going to be that variable costing income statement. But for the time being, let's just talk about how we can assemble this. So we know in order to produce this income statement, we're going to need to start with our sales. We subtract out our cost of goods sold, and that gives us our gross profit. Once we subtract out the selling and admin expenses, we're left with our income from operations. Okay, so there could be some type of income from a rental property or something that's not related to the operation of the business, and that would actually be, shown after this income from operations, and it would be calculated into net income. But basically, you can just think about income from operations as being net income at this point. So our sales were $9 million. It's going to be the same under either method, the number of sales are. And here, this is where we're determining how much of these units are going to be expensed under cost of goods sold. Now these guys here, this $210, that is calculated by looking at the problem. It tells us the amount of direct materials was this, the amount of direct labor was this, the amount of variable overhead was this, and the amount of fixed factory overhead was that. Remember, we produced 40,500 units. So for each of these, we're going to divide it by 40,500 to figure out a per unit amount. And what we come up with is $210. We saw that we only sold 30,000 units, so we multiply 30,000 units by the product cost per unit that we've come up with of $210. So we have our $9 million minus this right here, which is equal to $6,300,000. That gives us a gross profit of $2,700,000. Our selling administrative expenses were just given to us, weren't they? We don't even need to worry about putting these on a per unit basis, the way we're working in this case at least. So we take the gross profit, subtract out the total of those selling and administrative expenses, and our income from operations is going to be $1,215,000 under the absorption costing method. Now, before we even assemble the variable income costing method, or the variable costing method income statement, I can even tell you what the answer is going to be. We're going to see, let's see what it would be here. Okay, so we sold 30,000 units and we produced 40,500, right? Isn't that what it told us just a second ago? Let's go back to the original problem. So it says that we sold 30,000 and produced 40,500 units. So that means that we produced 10,500 more units than we sold. So we built our inventory up, didn't we? We built our inventory and we increased it by 10,500 units. So 10,500 units, once we know how much we increased our, once we know how much inventory we increased, we simply multiply it by this number right here. $18 per unit is the fixed factory overhead per unit. So if we multiply 18 times 10,500, we get a difference of $189,000. Now, because we increased our inventory, we know from reading in the chapter that absorption costing is going to give us a number that's larger for income from operations than the variable costing method. If there's a situation where we sold more than we produced, it would be just the opposite, and the variable costing method would have a higher net income. The book tells us that, and it's just the way that the math works out. So if I look at this $1,215,000, and I know this has got to be $189,000 different, $189,000 greater than variable costing method. All I need to do is say this number here minus 189,000, and I'll get $1,026,000. So let's actually go down here and take a look and see what we end up getting. Ta-da! Magic, right? Let's work this here legitimately together, and then we're going to see what the difference is too. But what I did there, it's very easy to do, and you can use that to check yourself. Look at the change in the inventory, multiply it by this per unit amount here related to fixed factory overhead, and that's going to give you what your difference will be. Okay, so with the variable costing method, we're going to need to figure out what we're going to use per unit. We know that we're going to use this. There's nothing different between this, or this. The direct materials per unit, the direct labor per unit, or the variable factory overhead. The only one that's going to create a difference is this last one right here, this $18. We are going to not even worry about including this as a product cost under the variable costing method. So if we add these three guys together right here, 111, 54, and 27, we get 192. So we start with our sales number. That's the same under either of those two methods, isn't it? And then we take out our cost of goods sold, our variable cost of goods sold. This excludes that 18 bucks we talked about. So we sold 30,000 units times 192. So that gives us $5,760,000 here. The difference between those two, 9 million minus this 5.76 million, gives us our manufacturing margin of $3,240,000. Our variable selling and administrative expenses are given to us in the problem, and they total $1,260,000. So the difference between the sales and all of our variable expenses is $1,980,000. And we refer to the difference between our sales and our variable expenses as our contribution margin, right? Contribution margin, that's what we call it. Next thing that we need to do is subtract out the fixed expenses. We need to subtract out our fixed selling and administrative expenses right here, this $225,000. And in addition, we're going to subtract out all $729,000 of these fixed factory overhead costs. See right here? Fixed factory overhead, $729,000. we're not even going to put that on a per unit basis. We're just going to subtract that whole thing out and treat it as being a period expense. So what we're left with here is $1,026,000 as our income from operation. Let's look below here. And this is a little explanation here for us with respect to why we're going to see the difference. And like I mentioned before, we have our increase in inventory multiplied by the $18 per unit, which gives us $189,000 is going to be our difference in income. Okay? So like I said, you can use that as a way to check yourself. Please let me know if you have any other questions, and have a great week.